Joining us now, Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Danielle, great to have you back.
Caroline, thank you for having me. Good to be here.
So Danielle, stocks are lower today after a hotter than expected CPI report. Do you look at this as a pause after a huge rally, or is the market starting to worry about inflation again?
Well, I think the market's been worried about inflation for some time. In fact, it's kind of unusual for markets to do what they're doing today. Usually it's, buy the rumor, sell the news. That actually conforms exactly with what the market is doing today. They're selling the news. But I think what's more interesting is that Kevin Warsh is really going to be walking into a minefield. And I think that that's what markets are beginning to convey.
Explain the minefield for us right now, especially on the heels of the better than expected jobs report. Inflation that, of course, is sticky, but what are the biggest mines out there?
Well, I think Warsh is young enough to know that he shouldn't follow seasonally adjusted ancient data that is very lagged in nature and constantly revised. I think any young college graduate right now could tell you that the unemployment rate is very misleading and that the underemployment rate tells you a better story. I think Warsh is a young enough and dynamic enough new leader to appreciate more alternative data sets, let's put it that way. But when it comes to inflation, this gasoline persistence is really going to test him. What we saw in this morning's CPI report, though, is that companies are having a hard time passing these higher costs along to their customers. So we'll know more with the PPI report tomorrow. But this is a very stagflationary environment with a job market that is not as robust as some of the data would suggest.
You've been warning about cracks in the labor market for a while now. What are you seeing beneath the surface that concerns you most, that the data and the headlines aren't reflecting? What are investors missing with the stock market lower today, although the Dow has just turned positive, that concerns you most?
Well, I think most of it comes out of the survey data and the fact that we're seeing so many white collar workers lose their jobs. This drags on income more than if a lower paid worker was to lose his or her job. We're seeing it in the University of Michigan. We're seeing it in the conference board. We're seeing it in other gauges of job insecurity that are only with the only parallel we have is the 2007-2009 Great Recession. So there's a huge disconnect right now between the official data and what Americans are telling us.
There's also a big disconnect between what the stock market is doing and what you're saying the economy is showing. Obviously, we know the stock market is not the economy, but why does it feel so disconnected right now? And what does that ultimately mean for where you think the market goes from here?
Well, you just mentioned the Dow turned green for the day. In 2000, 1999, we saw days like this when the tech sector that had run up incredibly. I mean, there aren't enough sigmas to explain how quickly the Philadelphia semiconductor index has risen. It's just been remarkable to witness. But sometimes when things rise parabolically like they have, there are going to be setbacks. And so when you see the Dow green on a day that you see the NASDAQ red, that means that there's a lot of defensive posturing going on, people trying to hedge themselves.
What could the setback look like, though? Because despite the fact that we are seeing the NASDAQ down almost 2% today, it's still almost 2% away from all-time highs.
That's exactly right. And this is exactly what these types of cycles feel like when there are so many. A few weeks ago, had we said that West Texas Intermediate, that the price of oil per barrel was north of $100, you would have seen stocks in the red across the board. And that's not what we're seeing right now. So it's a very, very intriguing environment. And again, one that reminds me, showing my age, of what it was like to be in the market in 1999 and in 2000, when things would go parabolically up and then parabolically down. So I think, again, investors right now have to be very mindful of how they can protect their positions.
So what would a parabolic move to the downside look like? What are you actually expecting here?
It's very hard to say. It's hard to say if this is the last big hurrah before we have a long bear market, or if this is just a pause and we're going to continue to melt up. But this is beyond any melt up. Again, the SOX index equated to what we saw in at the peak of the dot-com boom. So we're in almost uncharted territory right now for the markets.
If your concerns about the labor market and really the broader economy are right, what parts of the market look most vulnerable from here?
I would say, just to borrow from Michael Burry in his recent warning, I would say that you need to be very careful of the price to earnings ratio. You need to be very careful of the integrity of the E in that equation, of how real the earnings are that are being reported out of the tech sector, which are beginning to be questioned on a more broad-based by more investors. The Financial Times had an article out last week that suggested that 39% of big tech earnings are kind of being fabricated, or at least flattered.
So where would you rather be positioned?
Well, I think financials are in the crosshairs because that is where a lot of the leverage that is backing AI is coming from. And we came into the year saying that, from the beginning of the year to the end of the year, you want to be long utilities, short financials. And we stand by that call given where we are today, which isn't very much different from where we were at the beginning of the year.
So for the retail investor listening in and thinking, oh shoot, that doesn't sound all that good, from Danielle DiMartino Booth, what is your message to them? What do they need to be considering, watching, paying closer attention to?
So when I was a young investor in my 20s, I had a sticky on my monitor that said, pigs get fat, hogs get slaughtered. That's still a mantra that I live by. And if you feel like you've made exorbitant profits in the market, well, then it's always safe to take some of those profits off the table. And then you don't have to look back and say, I didn't time the top perfectly. That's okay if you're taking a ton of profit with you.
What about those who are sitting in index funds, though, and just riding higher with the S&P 500?
Well, that's a different story. I mean, you're talking about a 401k investor here, and sometimes it's much more difficult for investors in funds like that to hedge themselves. I think it's time to pick up the phone and call and find out what avenues you have to protect your position. A friend of mine recently asked this very same question of me. I'm in a 401k fund. What should I do? She just picked up the phone, called Fidelity, and they moved her to a slightly more defensive posture so that she could harvest some of those gains.
What is it, though, what's the catalyst, you think, that finally forces investors to care more about the economy, which in your view is weakening, than things like AI enthusiasm and earnings growth that we have been seeing this earnings season?
Well, again, I refer back to today's CPI report that showed us that companies are having a hard time passing along higher prices. We're hearing constantly that credit card debt, automobile debt, student loan debt, you name it. We're seeing foreclosures rise as well. You know that the consumer is strained. You know that wage inflation, that the rate at which wages are growing is back to 2019 before the pandemic hit. So you know the consumer is squeezed, and it's coming through in the hard data. So in that sense, I think you're going to start seeing it filter through in a margin squeeze. And that is something that we've been writing about quite a bit.
If we do see a resolution to the war with Iran and we see oil prices start to pull back, I mean, U.S. crude is over $100 a barrel right now, but if we do see a meaningful pullback, say to maybe not 60, but 80, would you change your tone here in terms of how much consumers will be squeezed?
I would certainly think that if it was something that happened tomorrow, I think the war has ended about 9 times now, according to the headlines. If it was something that happened very quickly, yes. Bank of America came out with a report this morning, though, that showed that the rise in gasoline prices has already eaten through the rise in income tax refunds, and that the consumer is skating on thin ice because of that, because there's so little in the way of cushioning when the underemployment rate is at 8.2%, the cycle high.
You mentioned the strained consumer, and we'll hear more from some of the bigger retailers next week in terms of how their consumers are holding up. We know that the lower end is definitely feeling it the most from, places like McDonald's, for example, but they've remained surprisingly resilient at the same time. So What is it you think that finally causes households to pull back in a meaningful way?
Well, I think it's that top 10% of households who pull back that really gets the market's attention. And that would be a serious catalyst. And what we're seeing is, although they do continue to spend, the top tier, the top tercile, the top third of income earners parsed out in the University of Michigan, their confidence has really been falling in the future. So the volatility that they're seeing in the stock market is not something that is calming them. They've not stopped spending yet. To your point, the top 10% is still going out to eat and going on vacation and spending. But we are seeing a lot of hesitation come out in the surveys among those who earn the most and are at the top of that K-shaped economy.
You talked about Kevin Warsh at the top. He'll be taking over as Fed chair. Jay Powell's term ends on the 15th. You mentioned the minefield that he'll be navigating. Do you have confidence that he could, that he can do it? And what should his next move be?
Well, we'll see what happens with private credit and whether private credit spills into the public credit markets and tests Kevin Warsh as Jay Powell was tested when he was first chair in 2018. When markets misbehave, especially credit markets that feed into the stock market, whether you have great ideas for shrinking the Fed's balance sheet and you don't like quantitative easing and you're resisting zero interest rate policy and all of these wonky economic terms, as Mike Tyson said, everybody has a plan until they get punched in the mouth. And
all right,
we're going to see Kevin Warsh tested.
Sorry there. So help us with our plan. I know you're watching what you said is going on in the private credit market here. You look at the soft data, the consumer surveys. What else should be on our kind of checklist in terms of what we need to be paying attention to as potential warning signs?
I think people should be following the bankruptcy cycle more closely, and that is easily accessible data. We're seeing quite the pickup compared to 2025 in bankruptcies. It's now bleeding into personal bankruptcies. And that's one of the reasons why when we see continuing jobless claims reported every Thursday morning, we shouldn't go, oh, everything's okay. We should look further into the data and realize that of the 7+ million Americans who are unemployed, only 1 in 4 are collecting benefits right now. So we have to be very careful because there's never been such a disconnect, a divide between the bankruptcy cycle and continuing jobless claimants. But that has more to do with the fact that 3 in 4 are not even collecting those benefits. They're driving for Uber instead.
Okay. All right. I think it's a great time to transition to our rapid fire game of this or that. Quick questions, quick answers. Are you ready, Danielle?
I'm ready. Let's do it.
Soft landing or recession?
Recession.
2026 or 2027 story?
2026.
Inflation risk or growth risk?
Growth will supersede the inflation risk.
Consumer resilience or consumer exhaustion?
Consumer exhaustion.
Stocks, new highs or near a ceiling?
Definitely near a ceiling, but ceilings can be pierced.
Okay. Bigger market driver, AI boom or economic slowdown?
I think they feed into one another. That wasn't the answer you wanted, but I believe that's the case.
Defensive stocks or tech leadership?
Defensive stocks here.
Kevin Warsh as Fed chair, bullish or bearish for stocks?
Right now it's bearish. He's in between a rock and a hard place.
Warsh's next move, cut or hike?
The middle of it, stand pat.
Fed independence, intact or under threat?
Definitely under threat.
Stocks at year end, higher or lower from here?
I would have to say lower, given the two choices and given where we are today.
How much lower?
That I could not answer.
All right, we'll leave it there. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Thank you so much. Really appreciate it.
And thank you for having me.
If you enjoyed this conversation, check out our full street talk with Adam Turnquist, where he explains why he's still very bullish on this market.